Welcome back to another video. So today I'm going to be speaking about property, so real estate versus index funds. As a beginner, what should you start off with? You will be able to see, in my opinion, what I think you should start off with. Just kind of like as a side note, I don't think that as a beginner you should be diversifying immediately. I believe you should build up your wealth in the fastest way possible, which is to kind of concentrate into one thing. And then when you build up to some decent wealth, then you can diversify to protect that wealth. Because if you diversify from the start, then you're kind of gonna average out your returns low over the long term. So it's better to concentrate than diversify to protect your wealth. So yeah, guys, here are my thoughts of a tweet storm that I did, just explaining my thinking behind this. So yeah, hope that helps. Hi guys, so yeah, we're now inside my Twitter. So I did a recent tweet storm about index funds versus real estate. And I thought this could be good to kind of expand on it, make a video and explain a few things in more detail as well, especially for beginners. So yeah, let's get right into it. So the first thing I said was most people say stocks have higher return than real estate. Now, this is both true and also false. But when I'm talking about index funds, it often takes up to 30, 40, 50 years to kind of realize the full potential or the full returns of the index funds. Whereas in the real estate market, you can kind of do that in a way shorter amount of time. Say, for instance, 10 years or 15 years, for instance. So, over the long term, yeah, I believe this statement is quite true. Stocks do go way higher than real estate. However, when you're old, you don't really want to be enjoying your life of course you do want to be enjoying, but you don't only want to enjoy your life, when you're 65. And I believe the way to kind of reduce that retirement, so to speak, time or age, is to probably start in real estate, and then you can diversify into stocks. And yeah, I'll explain why I think like that as well. Now, I hope this helps, especially for beginners, like I mentioned. It's quite a dilemma because, real estate is one of the most common assets, as well as stocks as well. And it can be kind of confusing, especially right now when you hear everything is kind of hyped up, especially in the stock market. So it's kind of good to just explain it in a bit more detail. And another thing to point out as well is that it's not really advisable to kind of do these things both at the same time, unless you've got, quite a substantial amount of funds to start with. That's the reason I aim this at beginners. So I'm assuming that you can only start with one of these as an example rather than both of them, because the more you diversify, the less returns you kind of gonna get over the long term. So you kind of want to be concentrated on your investment journey. You want to concentrate at the start. Then when you build up that wealth, then you want to protect it by diversifying. Because if you diversify from the start, then you're not really going to experience the higher returns that are potentially life-changing. So yeah, let's go right into it. So I'm currently doing a bit of both, to be honest, just for transparency. And the reason for that is, I've only just started my financial journey, I would say, properly investing maybe the last 2 years. And I've managed to, get a decent amount of money to do both real estate and also stocks. Now, when it comes to real estate, I haven't actually invested yet. I'm kind of waiting for a sort of crash here in the UK in the real estate market, and then maybe I'll go in. But I'm also on the lookout, I guess, regularly in case, I guess, by deal by deal basis, because you might find something undervalued, and I would definitely go right in immediately as well. And I'm also investing in stock as well, as you can see from my channel. I started off in index funds and ETFs. I'm now transitioning into individual stocks just for that higher growth as well, higher returns. So yeah, like I said, I believe in index funds. I use them as well. I think, if you're really clueless about investing, they're probably one of the best things available, especially for passive investing, hands-off investing. So yeah, I do recommend them in that aspect. So I have some myself. So I invest, this is not investment advice, but I'm personally invested in the total stock market index in the US, which also includes the small cap stocks as well. So it doesn't only include the S&P 500 stocks. It also includes everything else, the small and medium caps as well. And essentially, that's where most of the growth comes from within the stocks. They actually come from small and medium cap stocks. That's where most of the growth comes in when it comes to ETFs and things like that. So it's kind of good to have some exposure to those as well, rather than just having the S&P 500, because the S&P 500 is basically the most established, or 500 of the biggest companies in the US. So to be honest, like for example, a stock like Apple, it's not really gonna 20x anytime soon. But you might find some medium cap stocks or small cap stocks. They're a bit riskier, but they've got higher possibilities of doing 10x, 20x, and or even more as well. So that's the reason I invest in the total stock market index versus the S&P 500 only. So that's one of my trackers. Or indices. I also invest in the emerging markets as well. So that includes APAC, as well as I guess South America and a few others. Now this is again just a bucket of fund. I don't actually pick and choose stocks from emerging markets. This is just done on a passive basis, similar to how I invest in the US. And also, you might be wondering, the US. The reason for that is because the US is, of course, the biggest stock market globally. So that's the reason I focus most of my funds in the US. So you get paid twice, or in two ways, when it comes to index funds / stocks. So one, of course, is dividends. So companies pay out dividends. Those tend to be more of the legacy companies that have been around for a long time. For companies like Johnson & Johnson, companies like IBM, companies like McDonald's, those type of companies are the ones that tend to pay dividends. I focus on growth stocks, such as Tesla, such as Lemonade, such as Palantir. So those type of stocks, they're in the growth phase, and they're not really going to be, again, in my opinion, they're not going to be wasting money and giving it to investors in dividends. They're going to keep plowing all that money into R&D for the foreseeable future until, so I focus on growth stocks, and they don't pay dividends, but yeah. And then you also get paid in price appreciation when it comes to stocks as well. So that's the stock growing over time as and when it's doing well, according to what the market understands as well. So those are the two ways you get paid when it comes to wealth, when it comes to stocks. And those two ways can create some substantial amount of wealth for you if you pick your stocks well. So just to explain a few things as well. So we have share buybacks, which is when the company kind of buys back its own shares. Now this doesn't usually translate into anything substantial for you if you're holding a stock. At best, it just shows us price appreciation, and typically it doesn't mean more dividends or anything like that. So an example is actually Warren Buffett's company. Now they tend to buy their own shares quite a lot, as and when they feel like it's undervalued. But as in the longer term, the investors in Warren Buffett's company, they don't really experience any growth or any benefits to that. So it's just something to consider. Another thing as well is, when a company pays down its debt, it doesn't actually translate into again, higher dividends or anything like that. It just improves, it just shows us price appreciation, if that. So those are the kind of the limitations when it comes to stocks. And then let's go into real estate, just so you can see the difference in terms of leverage and what you can potentially do with real estate as well. So the first thing, this is not everything, but the first thing I'll name in which real estate can generate wealth for you is market appreciation. Now, this is just generally the market moving up, and historically, the real estate market has always been going up over the long term. Of course, you might get years where it's down or where it's extremely high, and then there's a correction to follow, but usually it is going in upwards, similar to the stock market as well. So that's one. And then the second thing is forced appreciation. Now, this is actually one of the best ways to invest in property. So this is when you find a property below market value, potentially, or even if you do buy it market value, you can still improve the house. For example, renovate the kitchen, put new appliances, put really premium, for example, I don't know, wooden flooring or something like that, just improve the house overall. And that will kind of push the price of the house up almost immediately as well. And you can refinance and do other things with the money as well. So that's forced appreciation. It works for both under below market value properties, so really rundown properties, and you redo the whole thing. It can even work as well on properties that you've bought for market value, but of course not, the margins are a bit lower on that as well. And then of course you have rent, so cash flow. So if you have tenants in your property, they'll pay you rent on a monthly basis. We also have depreciation. So property has a lot of tax benefits, and depreciation is just one of them. So you can write off annually the depreciation of your property against any gains that you would have made. That would help greatly as well. That's just one. Now, I'm not a tax advisor. You can kind of consult with professional tax advisors for more informed information on that. And then another thing I mentioned here as well, so buying below market value. So if you find a really motivated seller, so that is someone who wants to sell the property for whatever reason, maybe someone has passed away, or there's a divorce going on, or they need the money desperately, and they just want to get rid of it, then you could potentially buy yourself a bargain and say, a property is worth, market value is £100,000 or dollars, and there's someone selling it for, let's say, $70,000 or £70,000. You're almost instantly making 30K if you buy that property at that price. So that's another way as well. You can kind of build wealth within property. Another one as well, which is not really spoken about, is negotiation. Now, you can't do this in stocks. You can't negotiate and say, I want to buy Tesla today. The Tesla stock, it's for example $1,000. You can't say, oh, I'm going to try and get, I don't know, buy it for $750. That's just not possible in stocks. You need to pay whatever the market is offering at that time. So whereas in property, you can negotiate hard. Now, this could be, for example, if you've got your own team, for example, you've got a builder that you've got a good relationship with, you can kind of save on those costs. If you've got a good relationship with a lawyer or anything like that, you can save on costs. And like I said, if you do buy, below market value, you kind of making money almost immediately, actually. So negotiation is actually a really underrated thing when it comes to making money within property. You can really, put your margins even higher than they would be just from negotiating everything, actually. And then, of course, leverage. So I'm not sure if people do this or not, but if I'm sure there's some people out there that borrow money to invest in the stock market, and I guess if it makes sense for them, it does. But typically, people don't tend to borrow to invest in the stock market. However, in real estate, it's totally acceptable to a certain extent. So, you might have, let's say there's a £100,000 property that you'd like to buy, but you don't have the 100,000. But however, you've managed to save up, let's say, even 10,000 or even 20,000. Now you can use that as a down payment, so as a loan, which is the leverage, as a mortgage, and go to the bank, and the bank will give you the other side, the other portion of the money. So, for example, if you do 90% loan to value, you put 10K down, and the bank gives you 90K. And that's the mortgage as well. So you can't really do that in when it comes to stocks. You can't really go to the bank and say, I want to buy this stock. Can you please give me a loan for this? That's definitely just a no-go. So that's something very unique to real estate, because most people don't buy real estate by cash. And the good thing is here as well is that banks are really willing to lend as long as you're not as long as you're not a risky person. So, for example, if you've got good credit score and so on, banks are really happy to lend you the money to buy real estate, because for them, it's not a good thing to have money in the bank. Banks need to. The main way banks make money is by loans. So they need to get rid of any cash that they have and loan it up to people. And they consider real estate to be kind of a safe asset. So as long as the person qualifies, banks typically are more than happy to lend people when it comes to real estate. So when it comes to stocks, the only way to buy them at a discount is if there's a correction, or you might exercise stock options, which are extremely risky. But yeah, your best bet is basically a crash or a correction in the market. And again, this is very difficult to do or to time. You could be holding on to a stack of money, waiting for a crash to happen, and it doesn't happen, and you're just missing out on those gains. Then you might go in, and then there's an immediate crash after that, and again. So it's very difficult to time the market in real estate. You don't have that much. You don't have any control, pretty much, of what's going on. Whereas in real estate, you're kind of in control of the asset from start to finish. If you're buying, you're controlling the price you're going to pay. To a certain extent, you can kind of try and bargain, and you can kind of walk away from a deal, find a deal that fits you and your budget and so on. And if you're renovating, you can kind of, take so many quotes from builders who are going to help you out with this project. You can kind of bargain where you're going to buy. You can add the appreciation, you can add the value to the house. So you can do a lot of things which are in your control versus the stock market. So yeah, and then you've heard of the saying, cash is king. Now, when it comes to property, nothing really beats property when it comes to property. So, as an example here, what I was saying is, in property, you get paid in rent and also in appreciation as well. So you kind of get paid twice. And if you do your deals well, you can actually invest in property and refinance and get your initial down payment out and do it again. And that's how most people actually build up property portfolios in real estate. And that's called the BRRRR method, which is BRRRR. And if you search that up, you can kind of see what it's like in more detail. So as a beginner, I think property is probably the best way to go. So for example here, if you were to invest in Merck and you're interested in the dividends, which is 3.6% quarterly, if you'd need around $500,000 or pounds invested in Merck only, just Merck, for you to get 5K monthly. Now that is a lot of money, and not many people have 500K just to invest in a dividend paying stock in order to get 5K monthly. That's the reason. But if you don't have, but you can still buy a property for 500K without having 500K. You can put a down payment of, let's say, I don't know, 50K or 100K, and then the rest you can leverage it with a bank loan. You're able to control assets in real estate without having all the money or the full cost of their asset as well. So that's the biggest thing in real estate, the leverage. And you just can't do that when it comes to stocks, like you can see in this example as well. So for you to be able to save up even 500K, that's going to take you potentially, for the average person, maybe even a lifetime or half of their lifetime just saving up just to get this. So by the time you retire, you're 65 and you can't travel, you can't do many things, you can't go hiking, you don't have as much energy as you are when you're 30, 40. So that's the reason, anyway, I say it's probably good to build up a down payment deposit and then look to get into property and make some money that way, and then you can diversify into stocks. But yeah, and then also tax efficient wise, now there aren't many tax benefits when it comes to stocks. When you sell, you kind of need to pay up, but when it comes to property, you've got a lot of options, like depreciation as the main one. But yeah, you can consult a tax professional for more information on that as well. But yeah, so like I was explaining here, it's much easier to use leverage, 80% down payment. So yeah, so just to conclude, yeah, like I said, it's much easier and more realistic for the average person without millions in the bank to, probably go into property with a low down payment and maybe do some forced appreciation on the property and then maybe refinance it to get that initial down payment out and potentially do it again and build wealth that way. And maybe the cash flow or even that or refinancing the property, you can put that money into the stock market if you wish. And build your wealth that way and diversify that way. But yeah, that's just my opinion when it comes to this as well. When it comes to property versus stocks. So yeah, that's my opinion. Let me know what you guys think. Hope that helps, especially when you're just starting out on your journey. You might be confused as, what should I do, stocks or property? In my opinion, you shouldn't do both. You should just pick one to start with and then build on that one, kind of concentrate on one. That's how you get the bigger gains. And then when you've built up a decent pot of money, then you can start diversifying and investing in the other. So for example, investing in stocks after you've got a few houses giving you decent cash flow. So yeah, let me know what you think, guys. Hope that helps. Guys, thanks so much for watching my video. If you enjoyed it, please do give it a like. And if you haven't subscribed already, please do so as well, and share it with anyone else you think would find this useful, just so we can get the channel out to as many people as possible and help them as well. But yeah, let me know your thoughts on what you think you're going to be doing. Are you going to be starting with real estate or stocks, or even both, if you've got enough? But yeah, let me know your thoughts, and guys, I'll see you on the next video. Cheers.